When delving into the realm of investment, the initial image that springs to mind is the intricate domain of the stock market. Amidst the multiple of charts and figures, confusion can easily arise. Therefore, it's prudent to dissect and comprehend the subject more comprehensively. Imagine you've established a business and now require additional funds for expansion or perhaps to indulge in a personal luxury, like a private jet. The question then arises, where can these funds be sourced? An intriguing solution emerges. Why not divest a portion of your company while retaining majority control? This is the essence of the stock market, a process known as an initial public offering. But how substantial are the potential gains? Consider the case of Mark Zuckerberg's brainchild, Facebook. In 2012, Facebook went public, offering 337 million shares at $38 per share. Impressive, isn't it? Yet, Zuckerberg recognized the demand for his enterprise and subsequently introduced an additional 84 million shares, bringing the total to 421 million. Astonishingly, all of them were successfully sold, generating a staggering $16 billion. In a matter of hours, Zuckerberg transformed into a billionaire. Initially, the stock price surged to $45 within the inaugural trading day, underscoring Facebook's promising prospect. However, the celebration was short-lived, as the price retreated to $38 by day's end. Alas, this marked just the outset of a series of challenges. Subsequently, Facebook's stock faced a downward spiral, plummeting to as low as $20 in the ensuing weeks, a mere fraction of its original value. A harrowing experience. To grasp this sequence of events, a deep dive into the foundations of the stock market is essential. In past times, stocks were primarily acquired for dividends. In theory, purchasing a stock implies ownership of the corresponding company, entitling one to a share of its profits. Imagine you purchased 10 Facebook stocks in January 2017. You're now a co-owner alongside Mark Zuckerberg. As your company, Facebook, rakes in a colossal $15.934 billion, the question arises, what portion is rightfully yours? Let's consider the specifics. You invested $1,300 to secure your 10 stocks. However, it's imperative to gauge the overall stock landscape, which consists of nearly 3 billion shares. While your individual stake seems modest, a positive perspective is warranted. In an ideal scenario, dividing the net income by the number of shares would yield slightly over $5 per share. This metric is known as earnings per share. Hypothetically, your 10 shares could accrue almost $54. Regrettably, in practice, these projections seldom materialize. The prerogative to decide how to allocate these profits lies with the board of directors. Their primary focus often centers on personal enrichment and corporate expansion, rendering individual shareholders' interests peripheral. Nonetheless, it's worth noting that not all figures in the market emulate Mark Zuckerberg's practices. For instance, Apple distributed dividends amounting to $13 billion last year, translating to $2.46 per share. Presently, the significance of the sum a company disburses pales in comparison to its stock price. Apple stockholders enjoyed a remarkable 33% increase in just a year, a considerable feat surpassing the market average. The phenomenon isn't confined to Apple alone. Apple, renowned for attaining a $1 trillion valuation, reached this milestone when its stock price crossed the $200 threshold. However, a revelation surfaces. Until June 2014, Apple's stock price stood at a staggering $645. Does this imply the company was already valued at over $3 trillion? The intricacies of the stock market can be bewildering. Enter the concept of stock splits. In this scenario, each share is subdivided into 7, consequently reducing the price proportionally. Although this transformation is purely technical, it opens the door for a broader audience to participate as Apple investors. Not all companies embrace this approach. Some, like Warren Buffett's Berkshire Hathaway, cater exclusively to seasoned investors. This stance is exemplified by the firm's reluctance to split its stocks, resulting in a mere 1.68 million shares. In stark contrast, Apple boasts over 5 billion shares. Consequently, a single share of Buffett's company commands a hefty $300,000. For those excluded from Buffett's exclusive investor circle, affordable alternatives exist. Buffett introduced Class B shares, priced at $200, rendering investment more accessible. The labyrinthine nature of the stock market ensures endless discussion, but this presentation must conclude.